All right, I'm going to talk a little bit louder, and so I think for this, basically for the rest of the day, I'm just going to run through as much stuff as possible. There's not a lot of practical stuff. What I do want, if you guys do have questions, shout out loudly and interrupt the lecture, and we'll just try and smash this stuff out and then go home. And then you've got a week before you get the assessment. So pay attention, go through this, and then and hopefully get out of here before 5 p.m. Okay, so the next half hour or so, I'm just going to quickly talk about other types of trust accounts that firms are involved with. The key thing to note here is that all of these things are still trust money, but they're accounted for in slightly different ways. And in relation to the general trust accounts, the ways that these other types of trust money are handled, or the bookkeeping's done, is easier. By and large, all of the other mechanisms that we have for taking trust money that don't involve plopping it in the general trust account are easier. They do, however, have their own rules, and they're in, again, the trust account guide. As part of your assessment, you will get questions on this, but you won't be expected to do a thorough worked example through it. So I'm going to talk about it. You can have a think about it, and hopefully in practice, when these things come up, you'll get a chance to put that into a bit of practice. But I'm just going to run through why these things exist, and just give you an overview of how the accounting or bookkeeping aspects of them work. So the first thing we're going to look at is controlled money. Controlled money is a special type of trust account that's set up where the law firm is looking after a client's money, but they're doing it in a separate bank account. And that separate bank account, they have exclusive control over. And so, again, that can be expressed in terms of elements, that it's money which is received or held by the law practice on trust. There has to be some form of instructions to hold that money on trust in a separate account. And only the law firm have access to that account. It's a separate bank account that's set up for the purposes of looking after clients, that's separate from a general account. Can someone just ping the aircon? Thank you. Okay. Now, controlled money is governed by the regs and the Act. And if you are going through and looking at the regs and the Act, they will go through and talk about controlled money in a separate little section. And it does have slightly different rules in terms of managing these things, but generally, the rules that they have for managing controlled money accounts usually not as what's the word, draconian, for want of a better word. They're not necessarily quite as harsh or onerous. Onerous is probably a better word. Controlled money accounts, there are rules for setting them up, there are rules for how you have to name them, and there are rules about who can have access to control that particular money. And the idea of this is that your clients can go and set these things up. It all has to be done in writing. But the bookkeeping aspect of controlled money is kept separate and distinct from the accounting that you do for your general trust accounts. All the stuff that we've done yesterday and today, controlled money accounts have their own separate sets of accounts. So you could imagine if you're doing a controlled money account and you're doing a manual trust accounting system, these things could be pretty cumbersome in terms of doing those. You also note that, like other things, this is from the Act, this is from the LPA itself, these things, making mistakes, both in the case of here with controlled money accounts, but also things in your general account as well, often attract penalties. Anyone know what's a penalty unit? How much is it? Anyone know? I think it's about $140. Is it? I think it's around about. It's an indexed amount anyway. Goes up every year. 140, might be more actually. Anyone here working in a criminal law firm? Don't remember the amount. Can't remember the amount. It used to be in the Penalties and Sentences Act, but I'm not sure whether. I think it's done by regulation these days. Okay. 130? Oh, yeah. So that's it. So all of those things, 50 penalty units max. Often, by the way, when you get things that are in an act, when it has the maximum amount, the actual amount that's prescribed in the regulations is usually much, much smaller. So, for example, your parking fines. Parking fines in the Transport and Other Road Users Management Act can be massive. We're like 50 penalty units for breaching some parking regulation. But when you actually go to the regulations that are crafted and created by the councils or the university or whatever bodies has the power to do that, they're usually much, 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 much smaller than that. Okay, so a couple of things to note here. They have to be this idea of exclusive control. You're setting up these accounts. It is something that is done and is looked after solely by the firm itself. Now, you've got the idea of setting these things back up. One of the I guess advantages of doing this, you can set them up with different institutions. It actually doesn't need to be an approved ADI. You can have it in any old ADI. You go down to Bank Misu. Again, does anybody have bank with Bank Misu? Anyone? There's no one in this room bank with Bank Misu. That's amazing. I did for a while and regretted it for a while. But in theory, if you want to set a controlled money up account, you could in theory go to them. It doesn't have to be in one of those lists of 11. Yeah, so there's particulars about how you got to name it, and like all of these sorts of accounts, usually you come up with arrangements with the ADI to do things like not charge bank fees to the controlled money account, charge it back to the office account. What's the point? Why would you bother doing and having these things? You can set things up for specific matters. And again, it can be a risk management thing. Because it's a separate bank account in a separate institution, it's not impacted or affected by anything that may or may not happen to the general trust account. The time frames for getting things in and out of controlled money accounts can be a little bit easier as well. The rules and regulations for doing things and paying things out of it can be a little bit different. And sometimes it's just easier to also account for the things separately. I've often wondered with these things, like how they've come to be. And you sort of, when going and researching them, you realize that it's this historical aspect, that you can have accounts that have been set up in the past, rename them as a controlled money account, give control over to the firm. Things like that can happen. And we'll talk also later about things like power accounts as well, where you can set these things up and it can be quite convenient. Because if you think about it, if you've got a controlled money account, if you need to go and determine whether or not there's money in account in order for us to draw a check from it, do we have to do any bookkeeping to do that? No. We just go look at the bank statement for that particular account. There's only one client in one particular matter, and so it can be a little bit easier to manage some of those things. People do and have these things and do set them up separately. It's also easy, relatively easy to go and move things like that and have it set up in conjunction with an investment account, which we'll talk about shortly, where you can do things to also move them in and out with less compliance than you need for the, what do we call it, the general trust account. You're moving things out. You can have separate investment accounts as well. Move things in and out for to save on a bit of that. Firm can charge fees with whatever it likes. Firms are allowed, in terms of clients, in terms of doing it. No, that's not strictly true. The Legal Profession Act does mandate you can't charge for some things, and for doing something like setting up a CMA, yeah, a firm would quite reasonably would be able to charge if a person did want to go and have the thing done separately. It seems like something that would be a reasonable disbursement in order to claim back. Some things, by the way, you can charge a fee, like a service fee for us to go and the hassle for us to go and spending the time to set it up. If, however, it's a disbursement, in other words, essentially getting the money back for money that we've outlaid, that can only be at a one-to-one basis. So if we go and get pay stamp duty, or we go do a company search, it's $9, we can't charge $25 for the company search. It's just a disbursement cost. So setting up something like this, I imagine that a firm would charge the time. Hey, this is going to take us all this extra time to go through and set up. We'll just put that into the client cost agreement. Okay. So what accounts do we need to keep? When you're given directions or instructions to go and set these things up, those things need to be in writing. And when things are given to you in writing, you must keep them. You must keep most records in most systems, but on a variety of things. Law firms under the LPA, things like tax records. 7 years is the default rule. Most firms, particularly if you're not having to pay very much for doing it, most firms with most documents will keep them for a bit longer than that before they can be thrown out. Why would they pick 7 years? Well, with a lot of these things, it sits with your the Limitation of Actions Act. What's the limitation of action for tort? Most actions in tort and contract in Queensland? What was it? 6 years. Oh, good job. Good job. Was this general knowledge, or have you guys done Keita's course? Probably both. Good work. Yeah, so most actions are 6 years, and so keeping records for just a little bit longer than that seems a little bit wise. But it's mandated by the QLS anyway. QLS have gone and plopped it into the legislation, validly passed through the Queensland Parliament, and so almost all of the records you've got to keep have got to be for 7 years. Initiating record. So you've got controlled money receipts, initiating record of withdrawals, register of controlled monies, consisting controlled money movement record. Oh, good gracious. There's a lot of words. Basically the same stuff is what you would have for your general trust account. And those trust account statements that you've done, you just do the exact same process for a controlled money account as what you would do for the general account, including the reconciliation process. And again, most of the time this is just computerized anyway, so it's a moot point. But we've got to explain it to you. You can know that people can choose to not put their money in the general trust account if they want to set one of these things up. It's got to be done in writing. Okay. What do we need to know? We need to know register. Oh, it's riveting stuff. This is section 51 of the regs, I think. Yes, legal LPR regs. And you've got to store all of this information and basically be able to document money moving from that. As I said, in practice, you just do the same accounting system as you would do for the general trust account. And just make note, though, you have to do essentially that set of accounts for each controlled money account. Now, if you think about it, though, each controlled money account is the equivalent of just one ledger. So if we think about when we're doing stuff in the general trust account, we've got multiple ledgers with multiple client matters. Here, we've got one client matter. Question? Slides? Yeah, it should be in both the docx file that's in the JCU, and it's also in the slides in there as well. And this, I mean, it's from the regs. This is literally just copying the section from the regulation. But because of that, you're not really creating a separate ledger. It's one ledger for one controlled money account because it's one client. So when I say it's essentially the same thing, you're doing all of the bookkeeping steps. Some of them are a lot simpler because the trial balance only has one entry. So they don't really need a trial balance as such, you just need a ledger balance because that is the sum total of what should be in a controlled money account. So if you think of it as just being a cut down version of the full general trust account, just to deal with one matter, kept in a separate bank account. Am I explaining that? Or is that relatively logical? Relatively logical. You are allowed to just go and keep them in one separate place, provided you've got clear written instructions to do that. What do we got there? So it's got the particulars, and they call it, there's slightly different names they use here. Controlled money movement. Things of going in and coming out. It's basically the equivalent of cash payments, cash receipts, and journal entries. Except, can you do a journal entry here? No, because there's no other matter you can assign or allocate things to, because there's only one matter for the controlled money account. There's no other ledgers that you can move things in. You have to literally, if you want to move money from a controlled money account into a client's other matter somewhere else, you've got to write a check out, do a payment,
and reallocate it and dump it off in one of the, either the general trust account if they've got other matters, or another controlled money account if they've got another CMA set up for a separate matter. Okay. So there's the regs. That's section 51, sub 5, and again the same thing. 15 working days. Go and do a statement. Going to list the practice. You've got to compile all of the controlled money accounts in one statement for the auditors. The receipts, in terms of the receipt itself, remember how the receipts, the form of the receipts is different in the trust accounts guide than it was for that assessment piece, that Terry's ones that you had in front of you. Fundamentally, this receipt is just the same. There's only a handful of differences in that it's got the name of the actual account somewhere. This over there. It's actually just got the name of the controlled management account. When you're issuing a receipt, that's where the thing's going into. Again, from a practical perspective, you would just maintain a receipts book for your general trust account and a receipts book probably for all your controlled money accounts. And at the bottom, you would write the specific controlled money account when you're doing the receipt. I mean, in theory, you could get a receipt book for every account, but that sounds just tedious. But then it's manual trust accounting. It's kind of tedious, is kind of part of it, part and parcel of the whole thing. So just make note, it's essentially the same as a regular receipt from a general trust account. It just has to note this bit. Clear as mud? It's like the hardest part is trying to explain why. Why would you ever bother doing this? There's risk reasons. There's, in theory, it's actually easier to bookkeep this stuff, in theory, because you don't have to go through and reconcile it. And the accounts can already be set up, and you can just change the name across and take control of it. That's just as a practical consideration. Yeah, so there are a host of reasons. You can also have authority inside the firm itself to specific people, associates in the firm, to deal with particular things. Leisha? Not by default. Now, I don't know whether or not you are actually allowed to set it up in order to earn interest, but I'll talk about investment accounts, which are allowed to earn interest in a second, whether or not they move them across to that. I'll get to that in a tick. And again, slightly different words. The controlled money control account example. So this is basically a combination of your cash payments and your cash receipts, just thrown in together. There you go. What have we got? This one here. Credits, deposit, got withdrawals, and we've got what's that one there? Paid to from reason. That one up there is for one particular CMA, and you've got another one down there. So you notice these? It's got the control management account. One CMA up there, a different one down there. You're throwing them all in together. Oh look, here are all the control management accounts that we've got. Here's a list of all of the transactions that we've got with them. So the amount, this balance at the bottom, is the sum of all your controlled money accounts together. And that's just a mandatory requirement of going and creating these things. But when you go, account example, that's, and this thing popped up there as well. It did pop up. Here, though, this is the equivalent of a ledger, essentially. So for this particular person, for that particular matter, these are the transactions that relate to it. So the previous one, all controlled money accounts, all thrown in together. This one is just this particular person's transactions. So in theory, if it wasn't for the fact that some checks take a while to get done and some deposits take a while to process, in theory, all of these transactions would pretty much align with that particular control management accounts bank statement. They should be. It's a lot easier to go through and cross-check those things as a result. Yeah. All right. And then finally, last thing with controlled money accounts, remember how I mentioned how for each, essentially the trial balance is essentially one ledger item, because one controlled money account is for one particular matter. And so the collection that you'd have of those, the full trial balance, would be all of the controlled money accounts added together. Why they make you do this and record them separately, I think it's just for convenience. So that sum there is going to be the sum of all of the controlled money accounts that your firm has, all added together. I said why they would do that, because you can't easily reconcile that, because you'd have to individually go and do a bank reconciliation against all of the individual accounts anyway. But that's the requirement that they have for that. The accountants in the room would just be going, why? This number doesn't mean anything. But them's the rules. That's the act and the legislation. That particular number is not something that you can easily go and cross-reference or check. It's not. It's really for reporting purposes, as a compliance mechanism. It's not that useful as an internal way of going and checking things, because you have to individually go and do the reconciliation for each of the accounts. All right, thanks. Well, that's all I have to say on controlled money accounts. There might be some questions in your assessment, but they're not going to be onerous, and you're not going to need to go and create these as part of your assessment for this subject. All right. Next step, transit money. What's transit money? That is when a firm is given some money and given some instructions to take that exact money and give it to someone else. So you are given some money and told this specific money is going to be paid somewhere else. And the key thing to note here is that by default, transit money doesn't go into the general trust account. And so there are some examples. These are all from the tag. If you are given a bunch of checks by a client and say, please take these to settlement, you don't put them in your general trust account, you hold on to them and you take them to settlement. But the Law Society says, oh, you got to write this down. You actually have to keep records of these things. But nowhere near as onerous as the records that you need to do for putting things in the general trust account. Remember all of this stuff that we have to do when you put something in the general trust account? Lots and lots of work. For this, you've just got to make note of the details when they come in, what it's for, what's the purpose of, when I've got to deliver it, and then make it absolutely clear in the instructions as to what we're going to do. So some examples there. Client delivers to the law practice 3 bank checks required to settle a property and pay the stamp duty. We don't need to put them into a general trust account. We just pass them on. Is that pretty logical? Is that, because again, you've got to appreciate that it is, strictly speaking, we're dealing with other people's money. This is still trust money. It is still trust money. It's come with us in a form that is to be re-delivered somewhere else. So often the checks that do come in, by the way, are already addressed to the third party anyway, or bank checks that have already been created and crafted. So in other words, the client has gone to, and if you go and think about it, look, if you're in the, very fortunate financial position to be, I don't know, paying cash for a house, you could just go on your own to the bank, get the bank check, go to the solicitor, here you go, take that to the settlement when you go and do it. Okay, and they trot away and do that. That bank check doesn't go into the general trust account, doesn't go anywhere near it. But the written instructions that come with it have to be recorded and noted down. That's really the key aspect, key thing to note about transit money. All right. So what you've got to keep, you've got to keep records of the instructions, the purpose, and as I said, out of good practice, the QLS recommend but don't mandate that you keep electronic copies. You just literally go and scan what the thing is, along with the key bits of information involved with it. But it's nowhere near as onerous in terms of the requirements of doing it. Look, when you're taking money off people, you've got to treat it as sacrosanct. When you're taking money and holding it in trust, because you want to lose that bank check. Well, I mean, you can go through the proper process with the bank to get the thing reissued, but it's problematic. Now, there is one rule, and I'll talk about it a bit later, and that's to do with physical cash. Physical cash can never be transit money. That always has to go in a general trust account, no matter what your client wants. Okay, and also they've noted there as well, other documentation. If there are other things that have gone with this instructions, oh look, here's all of the, here's the contract for this particular sale, or here's some supplementary information involved with the sale, or here's some additional instructions with times and dates where you've got to meet for the settlement. Other things that go with it should be copied as well and stored for 7 years. And that's transit money. Okay, there are times when firms have to deal with other people's money where there is some sort of direction or instruction to deal with it in a certain way. And we call this written direction money. And some examples of, oh, there we go, an instruction from an appropriate person, a family court order, a guardian officer that's been appointed, or officers from, I guess, from the PT as well, to go through and to do these things. It's basically where you've got, you're not dealing with a client. That's really the key thing to note. It's you're dealing with a person who has power to deal with money in a certain way, but they're not, strictly speaking, a client as such. And again, this is the thing. So you can have a person that's authorized in some way to do that. Someone can be appointed, power of attorney and things like that. So when dealing with this, the key thing to note is that you've got to keep all of the written directions and written instructions when doing that. And this, keep it here, about this legal entitlement. That is a legal challenge. That's a legal problem for you guys as solicitors when going through and analysing whether or not this part of the LPA is going to apply. A person has come to you, they've claimed to be X, Y, and Z, and they have power to deal with money in a certain way. You need to put your lawyer cap on and work out what their power is. You need to go and actually find, sometimes do some research to work out what that particular person and the power that's given to them, whether or not they can deal with money in that particular way. And again, that may actually involve, going through and reading a family court order or the power of attorney document and so on. These things are, they can require you to go through and analyze that in a certain way. The key thing to note, all of the stuff, there's a golden rule, make sure everything is in writing. So that if, from time to time you do get it wrong and it turns out that person actually didn't have that particular power to deal with money in that particular way as they've requested, at least you've got it written down. Okay, so just a couple of things to note. When you're dealing with these like associates, or like people with the power to give these written instructions or written directions, just make note that strictly speaking, they're not your client. And so while you do need to keep track of all of the instructions that you've been given in terms of dealing with money in a certain way, And of course, with these things, if there are these things, make copies of whatever instruments that have come into you. Just make note, they're not your client. You don't have to issue statements. And so that's the requirements for these things. They can sit in parallel with the other aspects and CMAs and putting things in the general trust account. But whenever you've got these directions from people who aren't your clients, just document it. Just make sure that everything, when people come in and they want you to do things, somebody walks into the office and says, oh, I've got an order for this and I can deal with my invalid husband's account in this way. No, come back with written instructions on stuff. Come back with written directions to move things out. And that is the stuff that's really designed to just cover your guys' backsides as solicitors anyhow. All right, don't know why I've done these the wrong way around. I'll read from the next slide rather than that one. This is the register of power. Now, power money is when the law practice itself is given authority to do something on behalf of another person. So the practice is given the power to act. So if the firm itself or associate of the firm, it's just defined in the LPA, is given power of attorney to act on that, either jointly or individually, then that has to be recorded. You have to have this register of powers that just details and maps those things out. Because it's not uncommon. One of the nice things about lawyers, in theory, is that we're trustworthy, honest types who know a little bit about the law and know about following rules and obeying rules and aren't cavalier. We're very, very prudent with how we go about doing things. And so in situations where a firm does have some sort of power to act, so there we go, we've got some examples there. Administering an estate. So therefore a firm ends up, or a person in a firm ends up being, or administering an estate in some way, or administering a trust in some way, has this power. The documents that give that person or the firm the power to do things needs to be recorded. I mean, this should be pretty logical to you guys, eh? Everything should be in writing. But again, putting your lawyer hats on, you're going to have to know how trust law works, how the POA Act works, how the succession rules work, these things. And this can be a little bit frustrating. Hey, does anybody here not do succession law? I don't know, kind of skip it. Yeah, I actually skipped it as well. I can remember doing community legal about 3 or 4 years ago, and the senior solicitor said to me, "Oh, Simon, here's his will, go and read it." I'm like, I don't know. I presume there are rules for reading wills. I had no idea. I had to pick things up. And you're going to find that. You guys will actually find out with your own legal knowledge. There's going to be areas, not just stuff that you didn't do, because, you know, not all of us do advanced commercial law or tax and things like that, or family law being another one. But there's also, you guys are going to find things that are going to get fuzzy. If you go now, finish your degree, do your PLTs, do criminal law for 10 years, then somebody hands you a will. You're a lawyer, you know what you're doing. You know, just leave in the back of the mind. Strictly speaking, yes, you can do that, but be mindful. Be mindful that, you know, hey, yeah, in theory I can do this. In theory I'm qualified to do this. In practice I'm going to have to go do some research. And I may be able to refer you on to a better person to do it. Because that referring things on is really important. Don't try and do everything yourself, because you literally, what was it? If you try to be a jack of all trades, you end up being a master of none. And law, pretending that you know stuff gets you bitten on the ass. That's my 2 cents on that. Anyway, flick that over. And so he said these powers can come about in a whole variety of ways. You can be a trustee, you can be an executor, you can be a POA. Just write it down. And there's the Trust Accounting Guide has this powers register where they want you to go and map these things out. This, and I personally think in terms of a register that holds just basic information, that's fine. But this is manifestly inadequate in terms of determining what the powers that a particular person has for that estate. So what you would have there is see attachment 1, or go to this file to actually open up the will or the probate, letter of probate, or whatever the appropriate document that details the power for a person to act in that place. This is just sufficient information to identify that such things exist. Okay, it's a pretty. I mean, it's actually a pretty small bit of compliance, but it's just something you guys need to leave in the back of your mind. Okay. Lawyers and trust accounts can have or be holding very large sums, and as you could imagine, if you're doing a conveyance and it's a $13 million property, and you've got that money in your trust account for a week, there is a non-zero sum of interest that would have been earned on $13 million in a week. We're talking some serious sums of cash for money that's just sitting there doing nothing. And so, yes, we can have mechanisms in place to stop the interest that would otherwise go to the Queensland government and the bank from to actually maintain value in these things. And so there's really two aspects to this. The first aspect, and it's interesting because when you read the Trust Accounting Guide, it's all blah, 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 and talks about it a lot at the start. Complete red herring. When they talk about firms that are investing under a financial services license, all right, this is almost no law firms do this. If you're going to have a financial services license, that means you are in the business of giving financial advice and investing money for clients, okay? And that is different and separate and distinct from legal practice, okay? Why did this come about? Because a bunch of dodgy solicitors on the Gold Coast were doing just this, and they lost all the money, and then the thing had to go through the Fidelity Fund. And so these days, the Queensland Parliament and the QLS were quite clear to say, no, if you are taking money from clients for the purposes of investment stuff, you must hold this license. All right? Otherwise, it's general trust money, and you're going to get done for that. And so they're very clear in delineating money that is held for the purposes of investment where the particular entity has this financial license. That's an investment, like any other investment, and carries exactly the same risk as what that investment has. You don't get the double chance of having a slightly risk investment, and being able to leverage off the Fidelity Fund of the lawyers if everything goes pear-shaped. No. So money that is received by a firm with a financial services license solely for this purpose of investing is not trust money. And that's really good. It's right at the top. There's a lovely little flow chart, by the way, when trying to determine trust money in the Trust Accounting Guide, where it says, ask a series of questions, and then it goes, is this trust money? No. And this one's right at the top. But it's a little bit of a red herring. It doesn't come up much. What does come up, though, is when money is entrusted to a firm in the course of legal practice, but it needs to be invested. We need to maintain the value of that investment. Because if we leave money in a bank account and it's not earning interest, it's losing value. If you're a trustee, are you allowed to do that? No. You've got to maintain the value of whatever is entrusted into you. And so, this mechanism is in place for law firms to move money into a separate interest earning account for a specific purpose and length of time, and that's to maintain the value of that account and then move it back in again when it needs to come out again. All right, so just make note that this, even though this section is written whether it's talking about financial services, it's not trust money, and down here the investment must be made in the course of legal practice for the ancillary purpose of keeping or enhancing the value of money or property, pending completion of the matter or further stages of the matter, or pending payment or delivery of the money or property to the direction of the client. So in other words, you can't leave it there forever. Once the matter is over, money's got to come out of that investment account and be sent off again. Oops. Right, much like the other forms of accounts, the controlled money and transit money, written direction, keep the documents. And in the case of this stuff, do it as a separate register as well. So you'll have bits that involve the actual investment itself, particularly things like what the interest rate is. So if it's a term deposit, for example, what's the interest rate going to be at the start? What's the interest rate going to be at the end? What's the interest rate going to be if it chops out halfway, which is usually 0? You know, note details of, what else is there? Repayment and maturity. All information involved with that particular investment needs to go in this register. And again, don't skimp on the details, and put ancillary documents in the same file, same thing as well. Say yes, because this, in terms of putting it in a little register, I'm not sure we actually have a little register in the tag. Is there one? Oh yeah, there is. This information for anybody that's done the slightest bit of accounting and finance is manifestly inadequate in order to analyze what the worth of a particular investment is. Right? You need much more information than that. But this is what the QLS requires us to write down when you're moving money into investment accounts. You notice when you're reading the trust account guide that it's almost like the person writing it got bored at a certain point. When they started in controlled money, and then they sort of got a little bit bored, and as you get towards the end of powers and red money, they're like, oh, they just don't really care, just slopped it in there. And you'll find that it has a lot of recommendations. QLS recommends this. QLS recommends that. Not strictly speaking in the rules, but let's be honest, if the Law Society tells you to jump, you jump. So this thing here, it's just a good idea to manage and map these things out and keep them in a separate register. And was it 7 years? Here's an example. And again, this is a bit like the controlled management control account here. Investment ledger, it'll just come up and say, okay, here we go. This bit here has been moved in, moved out. Well, these accounts should be invested somewhere else. It should say where. Paid to, received from, George Bank, Westpac, drawn from Westpac. So you've got, that's money that's come out again. The idea is that you're just basically keeping a list of transactions for things that have been moved out into investment accounts. I don't really have too much to say on that. At the end of it, you can create a ledger. And the ledger is essentially all, this one here, this is just for one. This is for one particular client, one particular matter, all of the transactions that were involved, taking money, usually out of the general trust account, putting it in the investment, and then putting it back again. And unlike other accounts, of course, these ones earn interest. So that gets added into there as well, credited to the client's balance when the thing's moved out again. That is the last slide, not for the day. Sorry if I raised any hopes, but from the actual accounting part. So from this point on, I'm just going to be talking about, I guess, more general aspects of trust accounting and things that the little gotchas that you are going to be required to know for the assessment and hopefully for legal practice too. So do we have any questions about any of this stuff at this point? Because it's going to be... and do you guys, I think it's probably better, I'll just carry on over the next while and we'll just smash it out and go home. Excellent. Costs. Lawyers like to be paid. So I've heard. I wouldn't know. But when you're in legal practice, one of the core reasons why you keep a general trust account are for those two lines at the top of that slide. So anytime you have a legal practice and you are having money paid in advance for work that you have not done yet, it must go into your trust account. Lennon, what does ex post facto mean? After the fact. Perfect. Perfect. Yeah, your Latin is fabulous. If you've already done the work and you were given money to pay for the work that you've already done, and that's already been itemized, given to you as a bill, and you walk in and you pay that bill, that does not go in the trust account, that goes in the office account. That's a golden rule of professional solicitoring in Queensland. All right, but assuming that we have done some work and there is some money sitting in the general trust account, we can actually take that money out, provided we jump through some hoops. Some hoops to jump through. I'll talk about that now. So the first thing to note is that if you've incurred costs in relation to this, look, search fees, company search, done title search, done, we pay the Office of State Revenue, we've done all of this money out of our office account that would cost directly incurred by our client, but we paid out of the office account, we paid firm's money to do that. Those costs can be reimbursed. You can't decide to add to those costs. They can be reimbursed on a one-to-one basis, those things. And that's one thing to note. I think that's just a useful thing to note. If you've got a client cost agreement, remember that your time is billed. So if you had to go do the search, yes, sure, we can't charge money, we can't mark up the cost of doing a company search, but we can have in our client agreement the cost of hours, or we can have fixed fees for things. So it's $700 for this whole matter. All right. In those situations, usually you don't do disbursements, you just charge the fixed fee. And the firm just pays all of those cost things themselves. But key thing to note though, remember we were dealing with other people's money. So what happens if, we've incurred $5,000 worth of costs or time, our equivalent billed hours, $5,000, and there's $5,000 sitting there, and the client calls up and says, oh, I'd like my trust money back, please. What can you do? What can you do? It's in that one there, it's in part 1, section 1A, subsection 1A, 258. You can exercise a lien. Remember what a lien is? It's a right to hold on to something until you've been paid. Something I should appreciate. Did either Chris or Tom teach you guys about liens? Because I teach it to the MBA students. And I appreciate it. I actually don't think I remember teaching it in the undergrad. Does he talk about liens? He does. Okay. Well, that's it. So liens can arise in a whole host of different ways. There's a lot of common law liens that pop up from time to time as well. But it's the idea that you can hold on to stuff until you've been paid. So you go to the mechanics. Do they want to give you the car back straight away? No, they want you to pay for it. So most mechanics will mechanically disable your car if it's sitting outside by removing certain components. So you can't just pick it up and drive away. That's holding a lien, a possessory lien in that case. Here, we're holding a lien across that trust account money, which means we do not have to disperse it until we've resolved the firm's costs. This is pretty logical, really. I mean, we have to be paid. We can't do our costs until the end, and if the person wants the money out, well, particularly for things like criminal matters, what happens if you do the matter and the client goes to jail? If you hadn't been paid in advance, you ain't getting paid ever. Yeah, they have the cost agreement has to outlay that. And I think it's actually got, and again, those that have spent time in Keita's class a bit more recently than me, I think there has to be an associated attachment that goes with it that outlines the QLS rules, the whistleblowing rules, and all sorts of other things that have to be disclosed up front. But essentially, it's a contract. So cost agreement is essentially a contract between you and the person who's hiring or employing you, and all of those things form terms of the contract. Contract law. You guys remember that? back with Rachel talking about contract law. That's essentially what it is. It's just putting all of that information in one place. But what you find, and this flows from things like consumer law, where naughty people in positions of power used to give people very complex, and we literally are the lawyers, giving them really complex documents. And so that's had to be pared back a bit. And so it's a requirement now to actually go, sit down with somebody and actually explain and make sure they understand what it is that you're going to incur, how it's going to be incurred, how, in particular, if there is a matter, it's going to go one way or the other, how those costs are going to work as well in relation to the firm's fees. So that's, okay, procedures. There we go. So I made that point before about objection, the objection period. So you've got, assuming that you have a perfectly formed, validly signed client costs agreement, and you've incurred legal costs, and you want to get paid for those legal costs, you can do that, but you have to do this itemized bill. I was going to bring one along. Diane did me one a while ago, where it details all of the work you've done, broken up into 6-minute increments, and you are allowed to see it and see the sum at the bottom of the total hours, the amount allocated for those hours, as well as all the disbursements. That has to be presented to you, and you have 7 days in which to object to that. All right, that's the default rule for doing costs. Oh, you can object to anything you like. It goes off to the QLS, and they will go and they'll investigate that. Usually, though, if that happens, then the 7-day period is suspended if somebody does make a complaint. So it's one of the things, if you really don't like your solicitor, make a complaint, because they won't be able to withdraw it until that's resolved, and it goes up to QLS. I'm not actually too sure what the QLS's policies are on that, whether or not they determine whether things are vexatious or frivolous from the outset, or whether they go in and do a full investigation. I'm not actually too sure. But there is a process for doing it, but you've only got a week, so you've got to call them up within a week. Look, ideally with these things, if there is a problem, first of all, is to go back to the firm itself. Say, hey, can you explain this? And then if things are problematic, then you call the regulator. Okay. What else is there? And look, these things are usually governed. Again, it's even though it's very heavily regulated, because we appreciate we are the ones with the legal knowledge. So it's a little unfair in terms of all, if you think of all consumer transactions, in terms of the power dynamics between the various parties. Don't get me wrong, there are other consumer contracts where there's massive power imbalance. You ever tried negotiating with an airfare with Jetstar? Good luck with that. But in terms of the underlying rules of this, they've appreciated in recent times that lawyers do get a massive advantage. They're literally writing these things out, so they've had to move them to be more standard form, move to make it more transparent and for people to explain costs and things up front, and have these time frames that people need to know about in order to object to things like costs. But fundamentally, at its heart, it's still governed by contract law. What's in that agreement is the agreement between the parties. And you guys would have heard the term sophisticated parties or sophisticated users or clients. Publicly listed companies, there's a whole bunch of rules that you need to apply to, when Joe Bloggs walks in the door, that don't apply if you're giving legal advice to, I don't know, Citibank. Anyway. Sometimes people disappear. They go AWOL. You're literally trying to call them, trying to call people and say, I have money that I need to give you. Please come and take this money. And you try, and you try, and you try, and eventually, look, there's a certain point in time where if you've tried and tried and tried for what, 2 years immediately preceding, you've got money, money's been there for a long period of time, does the law firm get to keep it? No. Alicia, where does the money go? goes to the public trustee. So that's something. So that these accounts, you do have to go and take reasonable steps to go find the person who has this particular money, and after a period of time, if you've got this money, you can't find them, then it goes to the PT. All right. Each of these slides, by the way, I think it's just one matter, one slide, one point. So just make note. Eventually, money goes away. You've got to give it to the public trustee. All right. Next one. Cash. I mentioned this earlier. Cash, physical cash, banknotes with pictures of the Queen on it, coins, can never be power money, trust money, control money. It always, can be, but it always has to go in to the general trust account first. When you receive cash, you can't. And look, it's kind of a little bit logical if you think about it. Oh, here's this bundle of money. I want you to deliver it to my friend Sione at midnight on the docks. A big bundle of notes. Like, no, that's not how this works. So fundamentally, physical cash, banknotes, and coins must go into the general trust account. This is just a piece of information. Yeah, tuck that away. And again, even though we can do things, again, subject to a power, and have the, you can still have the written directions, you can still have the powers, but it still goes in the general trust account first, and has to be drawn out in the form of a check afterwards, which takes time. That's just something, tuck that away in the back of your mind. 1% of your grade. So you notice that these bits here, this is an eclectic mix of things. You know that the day is almost over when you're just getting a little bit of information there, a little information there. It is way better when your brains are all dead to get this stuff now than it is to get it at the start where you don't know any of it's relevant. I mean, it's all a little bit relevant, but knowing how to do those checks and receipts was the main thing you did at the start. So what here, we've got names. Okay, so sometimes, and this is not uncommon, people are known by multiple names. You have people voluntarily choosing to change their names. You have people who change their names upon marriage. You have people that are known sometimes by a middle name or a pet name, a kid's name. There's a whole variety of different names that people are known by. You must record legal name, but you also must record any names that they're commonly known by as well, and make that clear in your primary documents when you're doing that, and in your ledgers and so on as well. That's one of those things. Again, this is the sort of thing that pops up as a gotcha on previous year assignments. Might appear in one now. These are the sort of things I'd expect you guys to go through and go, oh yeah, that rule. There we go. We spent 35 seconds on it. Must record all names. Proper name, aka strange name 1, aka strange name 2, aka strange name 3. So you do put the full legal name, just by convention, do that first. That's the clearest way of doing it. Barristers are not allowed to receive trust money. That's pretty much it. That's literally the rule. The barristers cannot get trust money. Barrister gets trust money? No. Barristers are not allowed to have trust accounts. Barristers are to be paid, and they are to be paid by firms with trust accounts. That is why they essentially the lackeys of the law firms in that sense. Barristers don't get me wrong, they like to be paid. And one of the irritating things about that is that being paid in finish a matter, you're a barrister, finish the matter, firm writes a check out. You've got to wait a few days for the check to clear, which can be a source of tension, particularly if it's just before there's some public holidays. You have to wait for things to go through because they have to run their own costs before these things are done as well. Okay, miscellaneous rule. Trust account statements. So at the end of each financial year, you have to give people that you have money in the general trust account, and in fact all of your trust accounts, you have to give them a statement saying how much money they've got. Statement, sorry, I've just done this on one slide, so it's a little bit slow, but it's essentially their ledger. That's essentially where that's at. You need to you give them a statement, which is a copy of their ledger. And you're required to send that out to all of them, assuming you know their address, at the end of each year. You're also obliged to do it if they ask for it as well. So they call you up. Oh, can I get a statement of everything? Okay. And this is different and distinct from your itemized bill. So they have their transactions from their ledger, or in the case of clients that have multiple matters, each of the ledgers to which they're associated with. Remember, the fundamental unit of trust accounting is a matter, and one client can have more than one matter. Okay, and if you produce these, note that whenever you produce these, the firm has to keep them. They've got to actually keep a copy of it. Alright. Now, we've been doing manual trust accounts for this whole subject, and again for your assessment, even though you'll be doing it all electronically, but it involves you to do some manual ones beforehand. So just make note here, yes, these things can be computerized. In most situations they are. There are rules for doing these and setting up trust accounts in digital form, and note that there are rules that are set up there that are really create a hybrid system. I've worked in IT for a really long time. It's not uncommon when going through the process of moving systems from manual to digital for there to be this transition period where some of the stuff is done manually, some of it's done electronically, and then trust accounting is no exception. And the Queensland Law Society, for those that have been moving to make things more digital, what they've done is that they've allowed some aspects for some firms to be digital, in terms of doing things, doing FPOS transactions, or accepting credit cards, but they're on a case-by-case basis. To call up QLS, say, we would like to take FPOS. Well, okay, you need to prove to us you've got this system in place, or we want to be able to skip writing checks and do direct deposits. Well, okay, you need to jump through this hoop, that hoop, and this hoop in order to do that. So a couple of things to note about the rules for electronic systems. Again, the software developer in me looked at these rules and I smile sweetly. Terry, when he does his classes, he says, I think these rules have been written by people who don't know much about computers. There's a couple of things to know, that they insist that in the system, that the system is not capable of deleting trust ledgers unless, and it's got some rule, unless the balance is reduced, and when it's deleted, a copy is kept in pen form. That is just the, yeah. It's quite hard to design a system that can put data in that you can't, with open access to, as all the developers have, take data away again. It's quite hard to do. And I worked for one of the big banks for quite a long time. Crafting an environment to do that is very, very difficult. Very, very difficult. It requires quite a lot of expertise and a lot of people, because you have to separate the roles out as well. Chrissy, can you push the button on the... Okay. And so there's a couple of rules. They've got all this one, rule 31 sub 6. The law practice must ensure its computerized accounting system requires input in every field of a data entry screen intended to receive information required by this division, including in trust records. Like, well, it seems like a bit of an odd way of saying, okay, you need to validate all fields. It's like, well, yeah, okay, thanks, QLS. What they have done, though, and this is part of this hybrid thing, is to insist that some things, even though you've got a fully digital system, you still have to print out. You still have to print some of them out, although in some places they've used printed, in other places they've used in a printable form. So printable form, presumably, I don't know, there's no case law on this, presumably means pretty PDFs. At least I think that's what it means. I think that's what they mean when they were writing this, but I don't know. I'm only an IT guy who teaches stat interpretation. I don't know. Now, so just make note, most of you though, when you're in practice, you'll be using digital systems. I'd be stoked. By the way, if anybody actually enters legal practice, please send me an email, however many years from now, and tell me about your experience using a manual system. I'd really, really like to know. If you're using a digital system, well, you can send me an email if you like, but I'm expecting that to be the case for most years, or at least in part. There may still be this hybrid thing, where you're doing some parts with one, some parts with the other. backups. Now, backups here, they're applying to both the, actually, I think they're actually meaning both the digital and the physical backups, but it's not really clear by the way this is written. So I'm presuming that they mean both, but I really couldn't work that out. But if you're going and you've got a digital system, you've got to physically have the backups, even in your cloud-based system. They physically want you to back it up somewhere else. And to take steps from those backups of all your trust account records from being damaged. It's possible here also they're meaning, if you're doing a manual system, you've got to photocopy everything. But if you're doing it digitally and you've got it in a cloud system, it's backed up in multiple places already. That's just how those things work. So I'll leave that one up to you guys. Yep. Physically moving, yeah. Yeah, back everything up. And so that's why, again, yeah. Yeah, that's it. All those things. It's got a separate location. The idea is that to move these things, and like, I mean, in ye olde times, in accounting risk, things like that, you make a copy of everything, and you store it in another place in case there's a fire and all the records get destroyed. But in practice, scanning stuff, and this is this thing, you can scan stuff, all right, and then keep it in another place, but it has to be a separate location. Does that mean a separate digital location, like a virtual place? Does that mean if I store it in this server and that server? I don't know. I didn't write the section. But again, in practice, none of this matters because when things move into digital systems anyway, those things, assuming that they're compliant with the QLS rules, will just automatically go and back up to presumably meet those hurdles. Because if you're crafting digital solutions for trust accounting, you have to get each of the components you do ticked off by the QLS. So really, if the only people in the room, which probably include me, that have actually started to go and write digital trust accounting software, these are the rules that you care about. The rest of the people in the room, you can store this one away in your mind if you really want to. It's up to you. Okay, other things about trust account records. Permanent form. Keep trust account records in a permanent form. So again, it's a little bit iffy in terms of whether having a printable form, like a PDF that's stored digitally somewhere, whether that counts. Arguably it doesn't. Printed or capable of being printed. In English. Oh, that's another thing. There's another little gotcha. I remember this. There was a question in a trust account. This is so annoying. Question in a trust account assessment. This is not Terry's one. This is a different one that had this. Can trust account records, do they have to be in English? And the answer is yes, but the definition that tells you this is in this definition of permanent form. So it's a requirement in terms of keeping the trust records that they're in English. But it's not actually in the definition at the very start when you start to do, the top bit of the Legal Profession Act or the regs when they talk about trust accounting. So that's a sort of hidden away gotcha. The laws of Queensland are in English too, so it's kind of a moot point, I would think, but I'm not sure whether that comes up much. And it's got there, it doesn't actually specify in the Act. I think it does in the regs. Most of these things, it's 7 years. You've got to keep records for 7 years. It's got a massive penalty though. You notice that? 100 penalty units. It's quite a lot. We're almost there. That one there. And so those copies. Remember how we said you've got to do your statements at the end, within 15 days of the end of each month. Like that, you've also got to produce the copies within that 15 days as well. So you can be, punctual on one and tardy on the other, and you're probably still in breach. All right. There are some definitions for the particular things that you need to keep. It's in, what section is it in? 237. It just talks about trust records in the broad sense. it's not delineating here between what we call the primary records, secondary ones being the cash books and the journals, and I guess the reporting objects at the end, your trial balance and so on, and statements that go to clients. Anyway, that's the end of trust records. Not the end of trust accounting yet, though. What happens if, you know how I said it's from time to time, there'll be money left over in your general trust account. You've written a check out, didn't get banked, we've got money left over. It's not too much of a drama, is it? Go and try and find the person, try and give them their money, and if you can't, it goes to the public trustee. However, when there is not money in the trust account where there ought to be money in the trust account, that is a bad day in your legal career. Terry has much more stories about this that I do remember him telling me about, and because this will happen at some stage, and it is a bad day in your legal practice, because these things can happen. You can have all of these control systems in, but they're not flawless. It doesn't stop a check being written out to or given to the wrong person and going, oh bugger. So this deficiency is basically where there ought to be money in the general trust account, and there is not, or any other trust account, CMA accounts, and there's not. It's fallen below that. There is quite a large penalty associating with that, and notice that they quite clearly in subsection 3 say that causing a deficiency includes being responsible. So, if you are responsible in some way to a trust account balance being deficient, yeah, that's extremely problematic. This is really problematic. It's got a very large penalty associated with it. What do you do? Well, the first thing to note is that if some deficiency is caused by some form of error, first things first, money comes in the office account, it tops up the general trust account. That's the first thing. That's just the golden rule. Oh no, it's something bad has happened. We've recognized that something bad has happened. Oh no, there's money missing. Move this across. What happens if the amount is $13 million? Well, yeah, you've got other problems. But assuming the amount is small enough for the firm to go through and do that, you move that in. However, there are other things you've got as well. Now, you guys are going to be solicitors, hopefully, at some stage. You'll notice that you have duties. Your utmost duty is to the court and the administration of justice. You will sign an oath to the court in your admission ceremony, and part of that is that all of these rules for being a practitioner are going to start to apply to you. You have a positive duty to go and contact the Law Society as soon as you notice any irregularity in the practice's trust accounts. And that is a legal practitioner associate. That is not just the principal, that is any practitioner in that firm. Interestingly, not people who aren't admitted as legal practitioners. So if you are working in a firm, you do not have this duty. The day you swear that little thing in front of Justice North dressed as Santa, you will have to, you've got a positive duty to do that. And you're going to be in breach of that duty, and you're going to be in a lot of trouble if you are, if you turn a blind eye to these things happening. Okay, and so basically, there's a whistleblowing mechanism as well. So if you think there is some form of irregularity, you can contact QLS, do it in writing, and you won't be held, or at least in regards to these two things, you won't be held responsible. If it's another person, I mean, obviously you can dob yourself in. You have a duty to dob yourself in if you've done something dumb. But if you dob in another person, there's a really strong whistleblowing clause here that says if it was someone else and I've blown the whistle on that person, I can't be held responsible for this. Not liable for loss or damage suffered. Another person as a result of that compliance. Now, while strictly speaking that is the case, that doesn't excuse you from the levy, the Fidelity Fund levy that gets increased by $1,000 for the next year. You don't get excused from that. It doesn't go that far. So if a lot of money's gone, well, that's how it. But that's really this key thing. The key thing I want you guys to take away is this positive duty. You have to go and tell people about it. Oh, 2 more slides, both on breach. Okay, so this is the last little bit. What are we coming up? 2 o'clock. All right, good work. A couple of things to note here. If there is money that's taken, all right, do you guys remember the rules in trust law, like the Rehallet and those cases, that first in, first out rules? It rings a bell. Yeah, you guys that have seen Tom a bit more recently than me. So you make note that those rules apply. This is a trust account with everybody's money going into it. First in, first out, first in, first out. That is why in ye old days, where they didn't have these fidelity schemes, that you'd have the person, you get your money out, even if it was your money that got stolen. If you've taken your money out first, then you're fine. The other people would suffer if you were the first one in, but they would. I thought it was the dumbest series of rules. But basically, the prevailing rights and equity of the various parties are just done in time. So if you were the first person to put money in the trust account, all right, and then another person does, and another person, and then half the money disappears. If you were the first one in, you're fine. The person who put the money in last, too bad. Which seems terribly unjust. It's not done pro rata. But by default, the rules of trust law apply to these sorts of trust accounts. Now, clearly, it's not an ideal system, and so that's why there's the Fidelity Fund. So the idea being that every lawyer in Queensland is going to pay for the sort of dishonest things that pop up from time to time. Sorry? So all the other practitioners coming in and suing them. Well, the trouble is, it goes back to deep pockets theory, which I talk to all the business students, and it doesn't really come up in law very much. The trouble with suing the law firm that have been dishonest and taken all the money is that all the money's gone. So that's the whole problem, is that we can't get the money. Because remember, the rules for tracing and equity are really strong. So if somebody's pinched a bunch of money, bought a bunch of gold, you can trace that, get a court order to get the gold and give it back, or transfer it back into the general trust account. These things only arise where there's no money. That's really the key thing. There's no defendant, really, or they're in jail and they've got no assets, or gone bankrupt because they've taken the money and blown it all. That's really the key thing. If there is money, then yeah, sure. QLS usually lead the charge on that in terms of trying to recoup money from naughty practitioners. You mean to cause the money to go? So say you've got a firm, you've got 10 solicitors, and one of them specifically dishonestly moved money out of the trust account. Yeah, again, absolutely. The other 9 members of that firm who are going to have to cough up in the meantime, because remember, these things, before they go to the Fidelity Fund, you go to the firm first. It's the firm's problem in terms of a deficiency in a trust account. And so the other 9 members will absolutely be trying to get money out of this party here first, but most of the time it comes up where, yes, you can get an urgent injunction. Most of the time, no, it's gone. The money gets spent in trust accounts, not usually on houses and boats. It's usually spent gambling, and on things that have just gone. They've gone, taken it, gambled it, lost. Oh crap! I'm going to jail. That's really the real problem where these things come up. Because if they have assets, it's fine. Take the assets and switch them over. Okay, and this is the very last slide. Oh wow, last slide of the day. Okay, what happens when the Queensland Law Society get involved? Now, you guys, for this, merges into Jamie's stuff. He'll go through and talk about the tribunal and talk about the Legal Services Commission. Just note there's actually some interesting points, and this stuff, I am going to assess you guys on some of the stuff, so this is going to require you to actually go and do a little bit of research. even though this is a practical subject, doing journals and writing checks out, it's still a university. It's still an AQF level 7 subject. You do have to go away and do a little bit of thinking, a little bit of research, not much. But just make note that just as a royal policy, the LSE and the Queensland Law Society are really hyper-vigilant about even the smallest breaches in trust accounting rules. They will smack you down with furious anger if you start to play fast and loose with some of these rules, moving things in and out of trust accounts, not documenting things, being tardy in terms of your accounting practices. Okay. Now, it's not uncommon, though, if you go and read some of these tribunal decisions, QCAT decisions, that the reason these things came about are usually practitioners, often sole practitioners, but or in small firms, having breakdowns. They're breaking down and doing things that they would otherwise, if they were in a firm of mind and body, would not have done. They would have kept it, been vigilant about it, they wouldn't have left it for a period of time, but the marriage has broken down, they lost their house, hit the booze, all of these other sorts of things. These things come in terms of life. And look, the LSE, they're not monsters. While they're there to zealously protect the interests of the law profession in Queensland, the QCAT is actually reasonably sympathetic in terms of life events. One curious thing, first thing to just note, is that they also say that, look, yeah, we're sympathetic to all of this, the stress that's happening in your life, but the whole reason you're here is to try and keep your practicing certificate so you can keep doing law, and law is really stressful. So that doesn't fit very comfortably together. So those things, and sometimes they've taken an almost a paternalistic approach and saying, look, maybe law is just not for you. And so that aspect can come into it as well. But the last thing I'm going to leave you on for this course is actually a really interesting point. There's some readings from this. It's I think it's I might have actually the wrong author for this. It's Thomson Reuters, chapter 7, where it's talking about some of the theory of trust accounting. One of the interesting points that they raise in this, I want to sort of leave you guys with for the, I guess, forever and a day, because for most of you this is the last time you'll have me as a lecturer. But leave you with this, is that when QCAT's going and deciding these things, now you would think that there would be a massive difference in terms of the penalty for doing things dishonestly as opposed to negligently, just making mistakes or being sloppy or reckless abandon in terms of your trust accounting. Right? You would think, logically, this one's really bad, and this one, while it's still bad, hey, you've got to keep your trust accounts up because Law Society says so, and we care about what the community thinks of the legal profession. In practice, though, it's not. It's not, and it's actually an interesting thing. Just going through and looking, I've been going through and reading some of these, and I do recommend that you guys go and investigate this a little bit more, because I'm probably, might come up in your assessment, who knows, to have a think about that, because what DuPont reckons is that it's the QLS and the Legal Services Commission, they're actually really quick to point out when bringing actions against practitioners whether things are dishonest or not dishonest. Sometimes they take great pains to say, in no way, shape, or form do we impugn on a person's honesty in relation to this. We think they're sloppy, lazy, tardy, inefficient, and shouldn't be practicing for those reasons. But we're not making any comment or claim as to whether they've taken the money dishonestly. And the reason for that, I guess, from some of these things, again, you might want to go and have a little read, is because if you are a solicitor and you are tarnished in some way with being dishonest, you're done. You're just done. The loss of reputation that flows from that is just inherently massive. And so that is something to just note. And look, it's also something for you guys. Again, most of you guys are going to be finishing this year. You'll be doing your PLTs, probably starting this year, I would think. And a whole host of you will be admitted by this, maybe even this time next year, maybe a bit later. But make note that being known to be dishonest is absolutely fatal in the legal profession. And so that's why we have these sorts of courses, to maintain the image of the legal profession in the eyes of the community. But note that you guys, as practitioners and people that are going out, particularly if you do stay in North Queensland, your reputation matters. And I'm supposed to be spruiking doing the advocacy course, and something that Judge Bolsh actually told us, that it's not common, but it's not uncommon for people to build up their reputations. Your reputation as legal practitioners, which starts now, in fact started 4 years ago, whenever you guys started law school, building those things up, and you can lose that reputation just with a few strokes of a pen or a few paragraphs in the wrong place to the wrong judge. Your reputation is pretty much everything that you'll have as a practitioner. And so I hope you enjoyed, I hope you didn't completely loathe doing trust accounts over the last 2 days, and I'll end the recording there, but I'll hang around for a bit and we thrash around some questions. So thanks guys, hope it wasn't too horrible, and I'll talk to you most of you soon. Yeah.